Hello students, welcome back. We are on a chapter called as retirement of partner. We have done a first module. Now let us move to the next module to understand what is undistributed profits and losses. Okay, in first module we have talked about revaluation of assets and liabilities. I hope you are clear with that module. Now moving forward, we'll understand about undistributed profits and losses. So there can be certain adjustments for this particular topic, that is undistributed, or we can also call it as accumulated profits and losses. So let us understand what is it. What is accumulated? So it is created over a period of time. It is accumulating over and over, right? And undistributed, I hope you know, which is not distributed due to some or the other reason, that is undistributed. Look at it. What is undistributed or accumulated profit? Sometimes profit of previous years are not transferred to partners' capital accounts due to any reason are undistributed profits. Right now we have to see the accounting treatment of it. We will not go in deep for the reasons of it. Okay, we will understand the accounting treatment. Profits of old firm kept aside for some with or without specific purpose are accumulated profits. So undistributed profits, accumulated profits. Now, old firm is obviously it is firm before retirement of a partner. Specific purpose can be to provide funds for specific purpose or to strengthen the financial position. We might have some specific purpose. So for that we have kept the profit aside. Now moving forward, let us understand. These are the examples of this undistributed or accumulated profits. General reserve, reserve fund, or any other reserve, workman compensation fund, profit loss account, credit balance. That itself means it is net profit, profit loss credit balances. Okay, profit means credit balance. Now, such profits appears in balance sheet on liability side as they belong to all partners. These are amounts which are kept aside out of profit. So these are the profits, and profits are of partners. Okay, so that is the reason we keep it on liability side. Profits we record on liability side. Also, if we are creating any reserve, if it is for specific purpose, we know the amount is payable for that purpose. So all the reserves, funds, profits we record on liability side. Okay, so liability for firm. Now let us understand also what is undistributed loss then. Here we go. Sometimes losses of previous year is not transferred to partners' capital accounts due to any reason. Again, we are not going into reasons. We will understand the accounting treatment of it. So, our undistributed losses, for example, profit loss account debit balance. Now, I hope you understand profit loss account debit balance is loss. Okay, undistributed loss, or it can be deferred losses or expenses like heavy loss due to fire 50,000 decided by partners to write off over 5 years. So unwritten off appears on asset side. So if we have 50,000 ka heavy loss on due to fire, then if we gonna write it off for 5 years, first year we gonna write off only 10,000, so 40,000, the unwritten off amount we will record on asset side. Then again 10,000, then 30,000, 10,000, 20,000 on asset, and so on. So these are the deferred expenses or losses we have. So such amounts are undistributed losses. Such losses appears in balance sheet on asset side as they are recoverable from all the partners. That is receivable by firm. That is the reason we record it on asset side. Like profits we're going to give to partner, it is our liability to give profit to partner. Loss we're going to recover it from partner. So that is the reason profits are recorded on liability side, losses are recorded on asset side. Here we go. Let us try to understand with example. So this is the old balance sheet we have. Liability side, asset side. Liabilities right now we have just seen. It is profits. On asset side we might be having losses. So what profits we might be having? This undistributed accumulated. General reserve, workman compensation fund, profit loss account credit balance. On asset side we might have profit loss account debit balance, and so on. There can be many. Okay, so let us understand on retirement of partner, balances of undistributed accumulated profits and losses are transferred to what? All partners' capital accounts, that is distributed in old profit sharing ratio. if nothing is specified. If anything is specified for some particular reserve or fund or any amount in this, so we will do accordingly. But if nothing is specified, we'll transfer it to all the partners. That is before retirement, we're going to do it. Okay, because the retiring partner also will be having share in this. He has worked for so many years with other partners. So before retirement, he gonna get his undistributed amount. Okay, that can be profit or loss. He gonna get it and then we will retire him. Okay, now let us understand. Journal entries for transfer. So like we have discussed in admission of partner also, we will be writing journal entries based on logic. If the logic fails in exam, you can have a magic. That is, you can by heart the journal entries, but that can never be the option for journal entries, by hearting. Okay, please understand it with concept. Transfer of undistributed accumulated profits and losses to all partners' capital account. Let us have journal entry profits on credit side and losses obviously on debit side. So here we understand accumulated profits account debit to all partners' capital accounts. Due to distribution of profit, partners' capital gonna increase, and that is the reason capital account gonna be credited. If capital increases, it should be credited. That is what we have seen. So partners' capital account is credited and accumulated profit we are transferring. So originally profit is having credit balance. Now if we have to transfer it, we're gonna debit it. That is the simple logic behind it. Okay, no need to by heart this. Keep in mind these two reasons for debit and credit. So in which ratio we're going to do it? We're going to do it in old profit sharing ratio because we are transferring it to all the partners. Okay, so that is the reason old PSR. Transfer of undistributed loss. So again, yet again similar logic you can apply. Due to distribution of loss, your capital gonna be decreasing, and if capital decreases, we will debit it. So all partners capital account debit in old PSR obviously to accumulated loss. Loss is itself having a debit. So now if we're going to, we have to cancel it. So we will be crediting it. Okay. So this is the logic we have. Now, as undistributed accumulated profits and losses are transferred to partners' capital accounts, they will not appear in new balance sheet. In old balance sheet, we are having these amounts on asset on liability side, right? Now we are transferring it to capital. So for new balance sheet, there is nothing remaining in asset or in liability side. Okay. Now, calculation of ratios. Let us understand this very well. Now, we are done with undistributed accumulated wala part. Let us understand about calculation of ratios. Like we have discussed it in admission of partner, there are certain ratios. Retirement as well, we're going to have certain ratios. Now, please understand, again, I'm reminding you, retirement of a partner gonna be a base theory for your death of partner chapter as well. Whatever we are learning right now will be same for death of partner. Additionally, we're going to have one or two more adjustments, but these adjustments are there in death of partner chapter as well. So please be very, very careful while learning this, because this will cover your death of partner chapter as well. Here we go. Whatever we have seen till now, not only calculation of ratios, but whatever we have seen till now, whatever first module we have done till now, whatever undistributed accumulated profits adjustments we have done, everything gonna be in your next chapter as well. So now let us understand calculation of ratios. Old PSR, it is profit sharing ratio between all partners before retirement. Obviously, old PSR is before retirement, before reconstitution, we're gonna have it. Then it is always given, and if not given, assumed to be equal. This we know already. It is always given in question. If not given, you have to assume it as equal. Moving forward to the next one, new profit sharing ratio. It is the profit sharing ratio between remaining partners after retirement. So once the retiring partner is gone, the remaining partner is going to have certain profit share. So the ratio going to be new profit sharing ratio. It may or may not be given in question. If it is given, superb. If it is not given, we have to calculate it. Okay. So how it is to be calculated is very simple here. Let us understand. A, B and C are partners sharing profits and losses in as 3:2:1. C retired. A and B decided to share profits in future as 3:2. So in this given information, we have old profit sharing ratio readily available. New profit sharing ratio also readily available. right? So 3:2:1 gonna be old PSR and 3:2 gonna be new PSR. I hope you understand this. This already everything is given in this example. Okay. Now moving forward to the next one, calculation of gain ratio. Like in admission of a partner, we have sacrifice ratio. For this, we have gain ratio. Okay. So gaining ratio, or it is also called as benefit ratio. It is the proportion of increase in profit share of remaining partners due to retirement of one partner. Obviously, one partner is going to retire. So whatever was the profit, the remaining partner is going to get more share, because now the one of the partner is retiring. So his share also the remaining partner is going to get. So that ratio will be called as what? Gaining ratio. How they are gaining it, that remaining share, how they are gaining it. Thus, GR is equal to new PSR minus old PSR of remaining partner. So, new PSR minus old PSR, that is GR. How can you understand it? No. You can understand no. GR is no. No is what? New minus old. SR was different. SR was on. SR ka formula was old minus new. So, O, N. Here, N, O. So, GR is no, SR is on. That is how you can understand. But, okay. Now, moving forward, let us have an example. ABC were partners sharing profits and losses as 1:1:1. C retired. So, their ratio, profit sharing ratio, old PSR is equal. Now, C is retiring. Look at it. This was the total profit available. Out of that, A, B and C were sharing equal profits. Now, before retirement, entire profit was shared by all the partners. But now, if C is retiring, his 1/3 share will be also distributed to A and B, right? So, that is what they are gaining. Remaining partners gonna get his share. Remaining partners share increases. Their share increases. This was their share. Now, they're gonna get some part of this also. So, their share increases. That is gain made by remaining partners. So, this is how we can understand it. The proportion of gain made by remaining partners is gain ratio. Whatever gain they are getting, in that proportion, we're going to have their gaining ratio. Thus, GR, that is gaining ratio, is difference between NPSR and OPSR of remaining partners. That is the reason we have seen that formula, right? NPSR minus OPSR. Here we go. Now, let us go to another example. XYZ sharing profits and losses in 3:1. After retirement of Y, X and Z decided to share profits or losses in the ratio 2:1. Calculate gain ratio. Now we have to calculate it. We have OPSR, we have NPSR, and we're going to apply the formula for GR. We will be getting it straight away. Here we go. Let's understand this is OPSR. Old profit sharing ratio is 3:2:1. That itself means 3/6, 2/6, 1/6. And we also have new profit sharing ratio as well. So, new profit sharing ratio is 2:1. That is 2/3 and 1/3. Here we go. Let us move to the calculation part now. This is already given to you. Now, we'll understand how to calculate it. So, GR ka formula is NPSR minus OPSR. Therefore, for X's gain, what will calculate? NPSR is 2/3 and OPSR is 3/6. So 2/3 minus 3/6, we have to equalize denominator. So obviously it's going to be 4 minus 3/6. So if we have to equalize this at 6, we will be multiplying it by 2. Okay, so 4/6 minus 3/6 going to be the calculation. So it is 1/6. For Z will calculate his share. New share is 1/3. I hope you can see this, 1/3. And then old share is 1/6. So again, we will equalize the denominator. So we'll multiply it by 2. So it is 2 minus 1/6. You can observe here. If you have a doubt, you can observe here. Now, it is also 1/6. So X's gain is also 1/6. Z's gain is also 1/6. So gaining ratio going to be 1:1 here. Gain ratio is 1:1. This is how we can calculate it. Now, moving forward, let us understand the next thing. NPSR, case 1 and case 2. What is case 1? GR is not given. How to calculate NPSR? That is what we'll understand now. How to calculate GR? We have seen it. How to calculate NPSR? This is what we'll understand. So in that we have two cases when GR is not given, and obviously this case 2 is GR is given. Gain ratio is given in question. So here we go. GR is not given. Case 1, GR is not given. When GR and NPSR are not given, old profit sharing ratio between remaining partners itself is GR as well as NPSR. So simple it is. Okay. For admission, we used to calculate the remaining share, then we used to multiply it by OPSR, then we used to get NPSR. Nothing is to be calculated here. If only OPSR is given, straight away it itself is your NPSR and GR. That is what they are saying. Look at it. The example. XYZ share profits in the ratio of 3:2:1. Y retired. This one, 2 share is retired. So calculate NPSR and GR. So whatever is remaining, you can understand it as their new share. That is 3:1. Look at it. OPSR is 3:2:1. Y retires. So we'll swipe it out. We'll scrap it. So the NPSR and GR is 3:1. So this is what we call it as method. What method? Why? Because whatever was there, I'm just telling you this, you'll not call it as method, you'll call it as when GR is not given. Okay. So what we have to understand here is, whoever is retiring, we have to just wipe it out. So it's gone, right? So that is why I call it as method. You can call it as GR, not given. Okay. So this is very, very simple. For retirement as well as for death of partner, we're going to have this. Now, calculation of new profit sharing ratio, case 2, if GR is given, what is to be done? Look at it. To calculate NPSR, outgoing partner's share is divided in GR. And to get new share, it is added to old share of remaining partners. Obviously, whoever is going out, his share will be divided in the partners, and then old share plus this new share will be their new profit sharing ratio, right? Old share plus this division of share of outgoing partner gonna be their new share. So this is what we're gonna do. Step 1, look at it. Gain is equal to outgoing partner share into GR, and then step 2 will be new PSR is equal to old share plus this gain. Okay, whatever gain they have made out of that outgoing partner share, will add it in their old share, they'll get new share. As simple as that. So let us understand the example. Many a times theory we try to understand, but we are unable to understand it. While example, it will be fixed here. ABC were sharing profits as 3:2:1. It is their old share. C retired from firm and AB acquired his share as 1:2. Please understand the English part here. This is not new PSR given. They have mentioned A and B acquired his share. C's share is acquired by A and B in this ratio. Okay. What is new PSR? That is what you have to understand. So that itself means GR is given here. Gain, how they have gained it in 1:2. So it is given. So OPSR we know 3/6, 2/6, 1/6. Also we know GR, that is 1/3 and 2/3. So here we go. Let us apply both the steps and we'll get the answer. So for solution, gain is equal to outgoing partner share into GR. Therefore, A's gain is outgoing partner share is 1/6. C is retiring, no? So his share was 1/6 into GR. What is A's GR? It is 1/3. So 1/6 into 1/3, it is 1/18. For B also 1/6, this will remain same, and his GR is, you can see here, it is 2/3. So 1/6 into 2/3, so it's going to be 2/18. So this is what we have calculated, gain. Now, let us understand how to get new PSR. The second step is this, old share plus gain, this. So what is old share for A? Old share for A is 3/6. So A's new share will be 3/6 plus he is getting 1/18. Again, we have to equalize denominator. Please understand this. So 9 plus 1/18. If we have to equalize this as 18, you have to multiply it by 3. So 9 plus 1/18, it will be 10/18. For B, same thing will apply. B's new share is equal to, now B's old share is 2 by 6. Look at this. Old share is 2 by 6 plus his gain is 2 by 18. So again, if we equalize denominator, it is 6 plus 2 by 18. Right? I hope you are getting this. Simple mathematics. We are equalizing denominator, so we are multiplying it by 3. So 6 plus 2 by 18, so it will be 8 by 18. So now what will be their new share? It is 10 is to 8, and 10 is to 8 itself means what? It is 5 is to 4. That is what new share is. So in this module, what we have covered is undistributed profits and losses, how to divide it in partners' capital, and also we have seen OPSR, NPSR and GR, how to calculate it if not given, and what treatment we should give, what calculation part we should have, what are the cases to calculate new PSR, that is also we have calculated here, we have seen here. So here ends this module. Keep on practicing for ratios until we study the full length questions.